Greetings, savvy investors, and welcome to the House Lux Estate channel. We're here to accompany you on your journey towards financial success and independence. Our mission is to provide you with top-tier investment advice, and today we're diving into the exciting world of dividend stocks. These little financial gems can be a powerful tool for building wealth, and we're going to break down the process into easy-to-understand steps. We'll be covering everything from understanding what dividend stocks are, choosing the right ones for your investment portfolio, diversifying your holdings, and the importance of reinvesting your dividends. Whether you're a seasoned investor or just starting your financial journey, we're confident that this guide will be beneficial. So sit back, grab your notepad, and let's venture together on this path towards financial freedom. Stay tuned as we guide you through the path to financial freedom. First, let's dive into what dividend stocks are. Picture this. You're part owner of a business. Sounds impressive, doesn't it? That's precisely what you become when you buy stocks, and if you choose wisely, some of these stocks will be dividend stocks. So what are dividend stocks? Simply put, these are shares in a company that return a portion of its profits to shareholders. This return is what we call a dividend. Imagine it as your share of the company's earnings, paid out regularly, typically every quarter. Now you might be wondering, why would a company want to share its profits? Well, companies do this to attract investors and reinvest their earnings back into the business. It's a win-win situation. The company gets the capital it needs to grow, and you, as an investor, get a piece of the pie. But here's the real charm of dividend stocks. They can provide a steady stream of income. That's right. Even if the stock market goes on a roller coaster ride, as long as the company you've invested in is making a profit, you'll receive your dividends. And it gets even better. Dividend stocks can contribute to long-term wealth accumulation. Over time, as the company grows and its profits increase, the dividends you receive can also grow. This growth can significantly boost your returns, especially when combined with the power of compounding, which we'll talk about in a later scene. Now let's address the elephant in the room. Yes, investing in dividend stocks does involve risk. As with any investment, the company's profits may fluctuate, impacting your dividends. But remember, the key is choosing the right stocks, which we'll discuss in the next scene. In a nutshell, dividend stocks are like golden geese. They can provide regular payouts, contribute to long-term wealth growth, and offer a degree of stability in a volatile market. Now that you've gotten a grasp on what dividend stocks are, let's move on to the next step. Choosing the right dividend stocks is a critical step in building wealth. It's not just about picking any stock that pays dividends. There's a bit more nuance to it. The first factor to consider is the company's financial health. You want to invest in a company that's financially stable, one that generates consistent revenue and has a strong balance sheet. This is important because a company in good financial health is more likely to continue paying dividends consistently. Next, take a look at the dividend yield. This is the annual dividend payment divided by the stock's current market price. It's essentially a measure of how much bang you get for your buck. A higher yield might seem attractive, but be cautious. An exceptionally high yield could be a sign that the company is in trouble and trying to attract investors. As always, balance is key. Look for a company with a reasonable yield that also shows potential for growth. The third factor to consider is the payout ratio, which is the proportion of earnings a company pays shareholders in dividends. A lower payout ratio could mean the company is reinvesting more into its own growth, which could lead to higher dividends down the line. Conversely, a high payout ratio might mean the company doesn't have much room to grow. It's a delicate balance, again, between current income and future growth. Consider also the company's dividend growth. A company that has consistently increased its dividends over the years is a promising sign. It shows that the company is not only profitable, but also committed to sharing its success with shareholders. Lastly, don't forget about diversification. Don't put all your eggs in one basket. A diverse portfolio with a mix of dividend-paying stocks from different sectors can help mitigate risk. Choosing wisely is key. With the right picks, your portfolio can flourish. It's not just about the dividends you receive now, but also the potential for those dividends to grow. Remember, building wealth is a marathon, not a sprint. Patience and a well-thought-out strategy can lead to a prosperous journey in dividend investing. Diversification is not just a buzzword, it's a strategy. This timeless piece of investment wisdom is one of the most effective ways to manage risk and maximize returns in your investment journey. So, what exactly is diversification? Picture it as a well-balanced meal. You wouldn't want to fill your plate with just potatoes, right? Similarly, in the world of investing, diversification means spreading your investments across various sectors, industries, and types of assets. It's about not putting all your money into a single type of investment, like dividend stocks from one specific sector. Now, why is diversification important, you ask? Well, it's a bit like an insurance policy for your portfolio. It can't prevent losses, but it can certainly soften the blow. By investing in a mix of assets that are unlikely to all decline at the same time, you can potentially reduce the impact of volatility on your portfolio. It's a way to hedge against the unpredictable nature of the market. When it comes to dividend stocks, diversification plays a crucial role. Even within this category, there are various sectors and industries to choose from. You could consider dividend stocks from established sectors like utilities or consumer goods, or perhaps even dabble in the tech sector. The idea is to create a blend that can provide steady returns regardless of how individual sectors perform. Building a diversified portfolio of dividend stocks isn't just about picking stocks from different sectors. It's also about considering other factors like the company's financial health, dividend growth rate, and payout ratio. These factors can help ensure that your portfolio is not only diverse, but also robust and capable of weathering market fluctuations. Keep in mind, diversification is a long-term strategy. It's not about making quick gains, but about building a resilient portfolio that can grow steadily over time. So take your time, do your research, and build a portfolio that aligns with your investment goals and risk tolerance. Remember, never put all your eggs in one basket. Diversification is your safety net. This old adage holds true, especially in the world of investing. So embrace diversification and let it guide your journey towards building wealth with dividend stocks. Reinvesting dividends, a powerful tool for wealth accumulation. Let's delve into this concept and uncover how it can significantly boost your returns over time. So, what is dividend reinvestment? Simply put, it's the process of using the dividends you earn from a stock to purchase more of that same stock. Instead of taking those earnings as cash, you're plowing them back into your investment. It's like a snowball that keeps getting bigger as it rolls downhill, gathering more snow along the way. Now you might ask, why should I reinvest my dividends? Well, here's the magic of it. When you reinvest your dividends, you're essentially buying more shares without having to dip into your pocket. As you accumulate more shares, you earn more dividends. And when those dividends are reinvested, they buy even more shares. This cycle continues, creating a powerful effect known as compounding, which can significantly accelerate the growth of your wealth over time. Setting up a dividend reinvestment plan, or DRIP, is a straightforward process. Many companies and brokerages offer these plans, allowing you to automatically reinvest your dividends back into additional shares. With a DRIP, you don't have to worry about timing the market or making regular investment decisions. Your dividends are automatically put to work, buying more shares and contributing to the snowball effect we discussed earlier. However, it's crucial to remember that reinvesting dividends isn't a guarantee of success. The underlying stock still needs to perform well. But when combined with a solid investment strategy and a diversified portfolio, dividend reinvestment can be a potent wealth-building tool. So there you have it, the power of reinvesting dividends, the magic of compounding, and the ease of setting up a DRIP. It's a simple yet effective strategy that can help you build and grow your wealth, one dividend at a time. Reinvesting dividends is a game changer. It's the secret ingredient to compounding your wealth. Let's recap on the wealth-building journey we've embarked on today. We started by understanding the fundamental concept of dividend stocks. These are shares in a company that pay you a portion of their earnings on a regular basis. We then moved on to the importance of choosing the right dividend stocks. It's not just about the highest yield, but also stability, growth potential, and the company's history of dividend payments. Next, we explored diversification, spreading your investments across various sectors and companies to minimize risk and maximize potential growth. And finally, we discussed the power of reinvesting dividends. Rather than taking those dividends as cash, reinvesting them can exponentially increase your wealth over time. Remember, building wealth with dividend stocks is a journey, not a sprint. The road might be long, but the potential rewards are worth the patience and diligence. Thank you for joining House Lux Estate today. Don't forget to subscribe for more financial wisdom.